Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Wednesday. It is December the 8th, and we're going to be opening up in about 2 hours and 1 minute to be exact. Now, as you can see here, the market is following through from yesterday. The Nasdaq is up, the S&P's up, the Russell's up. Everything looks up fairly proportionately, actually. So it looks like a reasonable rally. Now, we're moving quite a bit. As you can see here overnight, we've moved about 300 points, almost 300 points. So the market is volatile. And here is something that I'm not happy about, but something that I expected. While the Nasdaq is up 40 points, look at the SMH index. This is the semiconductor index. It's only up 0.14. So QQQ right now is up 0.27, where the SMH, the semiconductors, are only up a hair. I mean, a hair. And if you look at the major index, the semiconductor index, I'm not sure if it's going to give us a reading, but it looks like it could be a little bit overdone, which is what I've been saying. This looks like a little too much too fast, especially in light of the divergence. Divergence. I always talk about this divergence. When markets get too toppy, diverging. So be cautious of semiconductors right now. I think there's just too much too fast. And I think you'll still see upside from like AMD and NVIDIA, but the weaker ones may start taking a dump, and that may put further pressure on the QQQ. So keep your eye on that. We're seeing divergence there. Put the call ratio is actually looking pretty good. We're in the random zone. We're no longer above 1, as you could see here. We went all the way to 113, but we're back down below that level. But we're still not like at 80 or anything, or 70. So it looks like the market has more upside to go, at least the broad market, and that's what we're seeing this morning. Now, volatility, that's what I told you guys is the most important factor to look at right now. It's going down. Now, we could have another couple of spikes, but as you could see here, typically after these spikes that we see, it cools off. It cools off and it reverts back to the mean, and that's what I'm expecting to happen now. Not expecting too much from the volatility index. Number of stocks trading above the 50-day moving average, very stable, 61%. Also, if you look at the number of stocks trading above the 200-day moving average and the 50-day moving average, they're both jiving fairly well. And if you look at the small caps, you have a smaller number of small caps trading above the line versus the premium stocks, and that's fairly normal. It's fairly normal to have about a 10-point range or so forth. And if you look at the Russell 1000 versus the Russell 2000, you could see it here as well. So smaller stocks are having a harder time coming up from this rally, and they've been weaker. But with that said, they're still doing pretty darn good, and I'm expecting the stocks in the Russell 2000 to start showing us some upside. And the number of stocks trading above the 200-day is actually pretty good, so it's only a short-term rally. So keep your eye on the small cap stocks. They look like they can be giving us more volatility to the upside. Looking at the data, we have international trades in goods and services and productivity. The numbers were soft. They weren't they weren't too soft, but they weren't all that great. But I'll be very, very honest, and I'll be frank, and I'll be one of the few people that'll tell you this. The market is being driven by the fear of the Omicron. That's what's driving this market right now, which is one of the reasons why bonds are actually a little higher, even though the market is higher. Typically, there's an inverse correlation between bonds and stocks. And I'm expecting the bond market to go down some more. I'm expecting it to go all the way down to the 145 level. So I think we still have quite a while to go to the downside on the bond market. Let's talk a little bit about global economy, shall we? Give us a little bit of clues of what to expect. Stock market. Wednesday, Asia, after another broad rally, investors wagered that the new variant of COVID is not going to pose a big risk to the economy. Germany's going through its first change in 16 years. Germany's parliament elected Olaf Scholz as the country's 9th post-war chancellor. This will be interesting. 9th guy after World War II. Opening a new era of European Union's largest economy after Angela Merkel's 16-year tenure comes to an end. Bye-bye, Angela. Have a good one. Japan downgraded its growth estimates for the last quarter to even worse, from 3 to 3.6. And I did a story on the Japanese yen versus the US dollar. Japanese yen is going down, US dollar is going up, which means, folks, you'll be able to buy more Japanese goods and services for less, because if the dollar gets greater and if the yen gets smaller, you'll be able to buy more of their currency for less of ours. Just a little thing. So we may be seeing some upside deals on Japanese cars and trucks if that happens, because US will have a stronger currency, which means it'll be cheaper for them to buy Japanese products and services. I'm going a little bit above and beyond my usual analysis, but I wanted to mention this because I did a story on Japan just a few days ago. It might have been yesterday or day before. Days get away from me, but keep your eye on the Japanese yen. And if you look at the cross currency, the Japanese yen versus the US dollar versus the yen, you'll see the US dollar is going straight up and the yen is going down. Something to keep in mind, and it should actually help US get better deals in light of this inflationary pressure that we're seeing. But again, it's not good for Japan. Economists are forecasting a rebound for the world's third largest economy in the current quarter, thanks to recovering activity after the COVID caseload plummeted. Thank God. And also, Parliament is expected to approve a stimulus package of $490 billion. That's quite a bit. Small cap stocks did better than large cap stocks, something I told you about. I told you that smaller cap stocks have more upside to go, and they were oversold, and I'll kind of get into that in a few minutes. COVID, the rebound this week comes after the market posted 2 losing weeks in a row, weighting down by concerns over the spread of the Omicron variant and mixed data on job market and worries on inflation. Fauci said less dangerous than the Delta variant, the O variant, and that's encouraged investors. And energy prices are just kind of not really doing much right now. Wall Street is looking ahead to next week when the Federal Reserve is scheduled to hold a 2-day meeting of policyholders that could offer an update on the central bank's plan to tackle inflation. Based on what we're hearing from Powell, I don't think he's going to do much, especially in light of the fact that this O variant isn't really causing a lot of trouble. The Fed has said its plans to speed up its pace, and that's what we're looking forward to. As I said, the bond market is a little weaker right now. I'm expecting it to cool off and for stocks to continue going higher, assuming that the QQQ and the S&P are going to go higher at the open, and they're still set to go higher. Let's look at the Dow. The Dow is set to open up 100 points higher, which is significant. And the S&P is going to open up, 1.27. Now, here's what I wanted to show you. If you look at the Russell 2000, and we were just talking about small caps a minute ago, here's my position. My position is they took too big of a sell-off, and they're really overdone, which is why the number of stocks trading above the 50-day moving average is depressed in the Russell 2000. Let me show you that right here. I'm kind of going back and forth, but I needed to show you this. So look at the S&P, 61% of stocks trading above the 50-day moving average, right? And look at Russell, 36%. Sorry, not 43%, 36%. So you got 61%, 36%. And I think that's going to shake out with the Russell going up and outperforming the larger stocks over the next few weeks because they took a really big dump and they went to a deep oversold territory below the 200-day moving average, where the Dow Jones bottomed out at the 200-day moving average, as I'll show you right now. See? And then the SPY barely, look at the SPY, barely went to the 50. See that? But look at the Russell. Oy vey, the Russell fell because smaller stocks are more vulnerable. So when you see something like that, they tend to move down. But, I mean, they went deep oversold, and we've been kind of choppy all year. So I'm not considering this a bearish move, and I'm considering the turnabout to the upside to be positive, and I'm long the Russell 2000 right now as a result. All right, now, today is Wednesday. Wednesday, I give you guys my hottest long, my hottest short, and today I'll even give you some stop losses and profit targets. How about that? So to the upside, I like Blackstone. This is a financial company with interest rates going higher. I think financial stocks will rock and roll. Now, we talked about this stock on 7/1 and on 7/12 when the price was $98. The price went all the way up to $150, and now it's pulling back to the $135 level, and I think it's bottomed out here. Now, I'd get in right around this price, and if it breaks a little bit below this level, the 128-ish, 127-ish level, I would get out. And I would hold this till about the 160 level. On the option, I would go all the way to March, and I would be looking at the 140. Let's see here, 140. I would be looking at the 145 strike price right here, either the 140 or 145. I wouldn't go too deep out of the money, probably the 145, and I'd go nice far to March right here, 145 strike price, nice and liquid, plenty of open interest, plenty of liquidity, traded yesterday. The spread isn't all that wide. I like the 145. And to the short side, I like British American Tobacco, BTI. I think the stock is a dog with fleas. If you look at it over, I mean, this stock topped out back in April and has been going down. And I would fade every rally. This one may have just a little bit more. I would keep an eye on this stock. And in this case, I would probably get into it around the 36-ish level. And if it goes to the 37.5, I would get out. And I would probably take my profit right at the 33.50 level. Just wait for it to make another lower low, like go down to this level right here, maybe the 33 level. But I think this is going to continue moving lower. And in this case, we'd want to buy a put option. And we would go to, again, March. Look at that. And in this case, we would go to puts, and we would want to buy the, right here, the 35 put, which is actually selling, great open interest and liquidity, and it's selling for less than $2. So for BTI, I like the 35 March put. Yes, the 35 March put. And for Blackstone, I like the 145 March call. And that's what I've got for you for today. But before you go, I've got a treat for you. And I mean a treat. No, it's not my typical pitch. I really have a treat for you. Folks, listen and listen good. This is coming directly from me. Many traders, they're feeling lost right now, which from what I've been hearing has led to trade losses and missed opportunities. Recent volatility, sell-off in small caps, all this O variant, it has pushed some people to give up on trading completely. I don't like this. Nothing pains me more than to hear that. I'm not kidding you. Nothing, especially when we've been having over 80% win rate lately. So for the first time ever, I'm going to say that again, for the first time ever, I'm hosting a complimentary bootcamp training session to teach traders 3 critical components of profitable pullback trading. There's not going to be any fluff. You're not going to see slides about how it's going to change your life and you sailing to Hawaii. It's the real deal, meat and potatoes. An hour, maybe an hour and a half, maybe even 2 hours of me rolling up my sleeve and getting into the meat and potatoes of trading. I'm talking about the real deal. The gloves are coming off. Click the link below to register for the training and download your free report to get started right now. This is going to be one of those sessions where you guys will be, Roger, I've never seen you do stuff like this before. The gloves are coming off. This is a real training workshop. There's not going to be any fluff. I'm going to repeat that again. No fluff, no lifestyle, just pure, unadulterated swing trading and how to construct a perfect pullback strategy, the best indicators, how to measure volatility, the risk level, the profit potential, how to measure the long-term and the short-term trend, how they connect together, the nexus between them. All that stuff. I'm going to talk about it at length. And if you guys don't bring a piece of paper and a pen, you're going to miss out on some amazing opportunities. I don't know if there's going to be a replay, but tomorrow the gloves are coming off. And I'm going to talk about how to construct profitable pullback trades. The same ones we've had over 80% success in real trades over since October 1st. And the market has been crazy volatile. Click the link below. Get in on this right now. Don't delay. There's no catch. I want to do this for you. And as always, make sure to like this video, subscribe to this channel if you're watching on YouTube. Hey, I want you to stay one step ahead of the market. You could do that by following these videos. And I want to hear from you. I'll respond. Send me an email, support@marketgeeks.com. Good comments, bad comments. What would you like to see me talk about here? Let me know. I'm here for you every morning before the opening bell. Bye, guys. Follow the link below. You don't want to miss this training. This is going to be the gloves are coming off Roger Scott's pullback session. Bye, guys. Have a great day and keep your eye on the market. Volatility is here for a while.